Hello and welcome. You're watching India Tonight and I'm Shrishti Sharma. Firstly, onto the show, let's go straight across to a big story on India Tonight, where we are putting the spotlight on the data that is coming from the United States of America, where the gross domestic product unexpectedly declined to 1.4% for its first quarter. And this is quite a reversal for the economy, coming off its best performance since 1984. A plethora of factors conspired to weigh against growth, like rising COVID cases, the Russian invasion, and soaring high inflation. But despite the disappointing number, markets paid little attention and continued to trade in the positive. But more importantly, investors shrugging off the fears and raising hopes that the US can actually avoid a recession. There were also a whole set of big tech earnings that investors have turned focus to. While Twitter missed onto the revenue front, Meta stocks surged as much as 13% on the back of strong earnings and propelling the tech-heavy Nasdaq higher, especially after the rout it witnessed a few days ago. To discuss all the action on the Wall Street as well as on the macro front, let me bring in across my guest, Nick Parsons, who is the head of research and strategy at the Thomas Lloyd. Nick, thank you so much for joining ET Now. Firstly, onto the GDP numbers that has been released recently. How do you look at the numbers and which factors you will blame onto?
Well, I thought they were an especially disappointing set of numbers. It's the first fall in GDP since the COVID recession. The thing that really dragged it down was inventories. And I think here is a warning about the dangers of inflation and the dangers of global supply chain pressures. Because had it not been for a big fall in inventories, the GDP number would have been roughly zero. Still a terrible number, but it wouldn't have shown a fall. And the reason that inventories fell is that a lot of manufacturers and a lot of retailers are simply short of stock. So whatever demand there was, they met by running down their inventories. That meant that we saw a decline in GDP on the quarter, but it also suggests that going forwards, we're not seeing much of a easing in those supply chain pressures. And the worry has got to be that when they come to restock those inventories, they'll be paying higher prices for it, and those in turn will have to be passed on to the consumer.
But Nick, what about the stock markets? Because just after the release, we did see that they didn't react that negatively. I believe that the results season and the earnings season has their own role to play into that. But going forward, how do you think that the investors are going to factor in all of these instances, given the fact that there are some concerns regarding the economy as well, and going forward, there are risks of the rate hike as well. So what's the action that you are expecting on the Wall Street?
You make a very good point there across asset classes. And I was watching a whole range of markets in the first 30 minutes after those numbers were released. And what we initially saw was that bond yields fell and also the implied rate on 3-month Eurodollars, that also fell. So as you might expect, we had soft economic data, and therefore the interest rate markets responded initially quite positively. And that's why we saw the stock market pretty much unchanged for the first hour or so after those figures. But then we started to see bond yields went back up, the money market rates went back up. And in the last half an hour or the last 1 hour, we've seen a big decline in US markets. And we're approaching now some very key levels. And if we have a second, I'd be happy to talk to you about those very key levels, because I think the month of May is going to be absolutely critical for how the rest of the year pans out.
Okay, but Nick, how do you see that whole tech basket? Because they seem to be today trying to show some kind of a resilience. They have two factors to play in. On one side, we see Twitter not actually making up to the expectations. On the other hand, we see a company like Meta that is up actually 13% in today's trading session. How do you see this whole basket, and what's your commentary on specifically these two counters?
Well, Meta, which is, of course, the parent company of Facebook, last night at one point was up 19%. So the fact that it's up 13% today sounds impressive, but it's actually already 6% off last night's high. And given that the bond yields, the reaction in the bond market was only very fleeting, that we saw a little dip in bond yields and then a rally again, tech is the ultimate long duration asset. And when you see a rise in bond yields, the rate at which those future earnings are going to be discounted rises, which means quite simply the present value must fall. So we had a tech bounce yesterday after Meta's results were out, but that didn't last terribly long. We're already 6% off the highs, and I think tech stocks have still got a very, very difficult period ahead. And as far as the broader market is concerned, we're now below 4,200 on the S&P 500. As we all know, the low for the year was 41.14. So therefore, I think it's right to assume that everybody who's trying to just buy a little bit here and try and bottom fish and try and hope for a turn in the market, everyone has got the same stop. Everyone has got a stop loss around 41.10, 4100. And if we are to break through that, and that's only 2.5% away from current levels, if we break through 4100, then I'm afraid it looks terrible. It could be absolute carnage for the stock markets below 4100.
Okay, Vidhans, thank you so much for joining us today at ET Now. Definitely